1 year ago, Jeremy Grantham predicted a massive stock market crash that would rival 1929, causing stocks to collapse by 90%. Since making his prediction, the S&P 500 would go on to rally 14%. Grantham's forecast turned out to be completely inaccurate. But instead of going into hiding, Jeremy sat down with Erik Saker on Bloomberg's Front Row to analyze his wild projection, giving the world a surprising update about his opinions regarding a future super crash, an opinion that is surprisingly backed by his own money and rational logic. While Jeremy was blatantly wrong in his original prediction, he refuses to admit his forecast was incorrect despite the rally following his wild announcement. This is how he started the interview.
Jeremy, a year ago, you predicted an epic collapse in stock prices, and you told me it would rival the 1929 crash and the dot-com bust of 2000-2001. Were you wrong?
No, I don't think so.
It's very apparent his opinion is that this recent market weakness is the beginning of the end, and he's got some pretty interesting facts to back up his claims. Obviously, there are dozens of investors who come out every single year and predict wild market apocalypses, but Jeremy's is a bit different. His evidence centers around something he calls the Great Divergence. You see, during massive super bubbles, indexes like the S&P 500 go strong until the very end. But what you will see in other parts of the market is a complete departure from this narrative. He points to the Russell 2000. This index is down about 15% in the last year. Meanwhile, the S&P 500 is up 15% during the same period. Historically, during bull runs, the Russell should outperform the S&P by 20%. Meaning, in theory, based on historical performances, the Russell should be up around 24% in the past year. This makes sense in terms of basic logic. If stocks are a measure of a business's future performance, why then are 2,000 small caps on a severe downward slope while 500 large caps are exploding upwards? According to Jeremy, this is the sign. How sure is he? Well, take a listen for yourself as he explains the certainty of his prediction.
At the risk of putting words in your mouth, you are as certain as you were then, if not more?
I would say clearly more. I did freely admit, not in our conversation, but elsewhere, that I wasn't quite as certain about this bubble a year ago as I had been about the tech bubble of 2000, or as I had been in Japan, or as I had been in the housing bubble of 2007. I used to think then in terms of near certainties. This time I felt highly likely, but perhaps not nearly certain. Today, I feel it is just about nearly certain now.
But it's the next topic that really captures Jeremy's analysis and makes for an interesting case. We know that the hallmark of any super bubble is crazy behavior. We've seen it before time and time again, but Grantham says that the crazy behavior is actually behind us and those 2 years of absurd speculation have ended. And we are now in what he calls the buy the dip phase. This, according to him, is something that happens in every super bubble cycle. A long buying frenzy ends and gives way to some magnificent runs that fail to live up to expectations, eventually tumbling into a massive crash. You can visualize this with the 1929 crash. As stocks began to crumble, the buying frenzy ended, but soon after there was a massive rally. This was the buy the dip moment. If you look in detail, towards the end of 1929, it looked like the stock market was going to make an epic recovery, only later to fall off a cliff. This is what Jeremy is referring to, and he thinks we are in this phase. In the distance is the cliff that nobody sees coming. The evidence he provides makes for a great case, but like everyone else predicting doom, the main question is, are they putting their money where their mouth is? If someone who is a financial expert truly believes a mega crash is coming, then they should let their clients and investors know that they should sell everything right now. The Bloomberg interviewer presses him on this exact topic, and Jeremy surprisingly responds with this shocking answer.
Jeremy, it's one thing to predict a collapse in stock prices. It's another altogether to tell investors they should sell. Should they?
As I said a year ago, I think they'll do pretty well by selling. I'm sympathetic to how difficult it is to get out entirely out of equities. And I would point out, as I did last year, that there are less overpriced parts of the equity market around the world. In fact, everywhere is less overpriced than the US. The US is the peak of this bubble as it was in 2000. And what it meant then is what it will mean today, and that is the US will decline a whole lot more than the rest.
In fact, Mr. Grantham is short both the Russell 2000 and the NASDAQ. He advises against shorting specific names, but believes that shorting indexes is a solid strategy, something you almost never hear from a man who manages money or runs a firm. And while he does add that taking a massive put position is commercially difficult, it's still nice to see someone who is predicting gloom actually put their money where their mouth is. He's not just fear-mongering, he's actually placing the bets. I'm sure if you asked various experts what they believe any investor should do, they would all tell you the same thing: buy and hold forever. And to be fair, this strategy has worked great over the last century. No matter the time period, passive investing has always come out on top. But maybe, just maybe, that party is ending. Grantham's bearish claim is actually much worse than anybody else. He provides a very specific warning to those who believe that passive investing is the way out of this mess. The example he uses is Japan. Japan serves as a reminder of the worst case scenario. If you were not aware, back in the 80s, the Japanese stock market went absolutely insane, peaking in 1990, before experiencing one of the worst crashes in modern financial history. Take a listen to Jeremy explain just how long it took investors to make their money back.
What if I'm a long-term investor, say running a pension fund or managing my own 401k, which I should add, I don't. But what if I'm one of those people and I look at history and history tells me that over time, independent or including crashes, stocks deliver a handsome return. And if I just stay in the market, I'll get that return, whether it's 7% or 8% or 9% or 10% over time.
You know, if you could set your dial for 50 years and throw the key away, that might make some sense. But let me remind you that in 1929, you didn't get back in real terms until about 1954. That's a long wait. In 2000, you didn't get back for 13 years. By modern standards, that's a pretty long wait. And in Japan, which is really the granddaddy of both bubbles, land and stocks, they are not back to their 1989 peak today. That is a very, very long wait. So if you think you can stand it for 10 or 20 or even 30 years, be my guest. But history says a lot of you will not stand it. A lot of you will become more conservative deep into this kind of correction.
That's right, never. A Japanese investor who placed his bets in 1990 has still, to this day, not made his money back. And you may be thinking, well, that's just an overseas market and it could never happen here in the United States. Well, it can and it has. Just as a worst case scenario, imagine you invested $10,000 into the Dow Jones Industrial Index in August of 1929. And then, 62 years later, you cashed that money out in July of 1991. Do you know what your inflation-adjusted return would be? 0%. Markets can take decades to recover from super bubbles, and we've seen this throughout history. And occasionally, given bad timing, even passive investing won't save you from the doom. Whatever the case may be, the evidence laid out by Jeremy is sound given the situation in the markets today. We are indeed seeing a massive divergence in the S&P and the Russell, and we've left most of the crazy behavior behind us. The SPAC ride ended last year, the GameStop saga has cooled off, and meme stocks have already plummeted well over 50%. The market seems to be in this bizarre no man's land where there are dozens of popular stocks that have been obliterated, while many of the large caps in the S&P 500 have remained relatively stable. 2022 will surely be an interesting year, and watching to see what happens will provide us with endless content and opportunity. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed it. And if you have a moment, please follow me on Twitter. The link is in the description below.